Have you seen our research piece, Investor Liquidity in Hedge Funds, Empirical Analysis of Costs and Benefits? It's in the publication section of ActiveAllocator.com. Hi, I'm Samir Jain, founder of ActiveAllocator, and in this paper, we examine two closely related questions regarding hedge fund liquidity. Are less liquid hedge funds better? Is there a performance cost associated with enhanced liquidity provisions? And if so, what are the benefits and drivers of this? So to answer these questions, we conducted a series of statistical analysis upon a broad sample of hedge fund returns taken from popular databases. And we concluded that the more liquid funds impose real costs on investors. And these costs manifest in terms of lower investment returns relative to less liquid hedge funds. Across the three dimensions of liquidity that we examine, lockup period, notice period, and redemption frequency, the data suggests that the more liquid funds underperform. So the flip side to the cost of liquidity is the apparent premia that may be available to investors in more illiquid funds. So while hedge funds offer investors better liquidity terms than, say, private equity and private real estate funds, I guess the same general principle holds. Investors should, and they do, get paid a premium for selling their option to trade in or trade out of their investments. We also found that the performance differences between liquid and illiquid hedge funds are primarily driven by the trading advantages that investor illiquidity brings to managers. So we considered three other possible explanations for liquidity cost: fee levels, investment strategy, and manager skill. And we are satisfied that none of these alternative hypotheses can explain the underperformance of more liquid funds. On the other hand, we find evidence that the more restrictive liquidity terms offer managers greater freedom to express their investment strategies, to expand their opportunity set, enabling them to outperform peers that offer less restrictive liquidity terms. What's interesting is indeed by matching funds from the same manager, our analysis is akin to running an experiment in which we change a fund's liquidity terms and evaluate performance differences. The result of this experiment is striking. Simply by making the change, on average, the less liquid version of funds tends to perform better. Of course, recognizing that enhanced liquidity often comes at a price, we hope it helps investors to make more informed investment decisions. This said, it is important, I guess, for me to stress that liquidity provisions should not be the sole dimension or even one of the most important dimensions to evaluate funds. So while liquidity restrictions seem to provide fund managers with additional trading advantages, I guess we still ought to devote considerable resources to analyze whether fund managers really add value, and importantly, whether their strategies fit well within an investor's overall portfolio. So I am not suggesting that liquid alts, alternative mutual funds are a poor man's hedge fund. And I'll leave it to you to make your own decision. And if you find our research useful, and I hope you do get in touch with me. Thanks for listening in.